Welcome to your custom deep dive learner. So let's start with a business paradox that, honestly, it just completely defies conventional wisdom.
Oh, it completely flips the traditional business script. I mean,
Yeah.
we are so conditioned by, modern tech and startup culture to believe that growth at all costs is the only valid metric.
Right. Like if the top line revenue isn't going up, the immediate assumption is that the company is failing or at least stagnating.
Exactly.
But imagine a company that loses nearly 40% of its new customers in a single year, watches its revenue shrink, and yet somehow they're popping champagne to celebrate their 20th consecutive quarter of profitability.
Yeah, and all operating with higher profit margins than when they were actually bigger.
It's wild. So that is our mission for today's deep dive. We are unpacking the unaudited first quarter 2026 financial results of Sunlands Technology Group.
Right. They trade on the New York Stock Exchange under the ticker STG for anyone following along.
Yeah. And for context, Sunlands is a major player in China's adult online education and personal interest learning market. This report we're looking at, it was just released on May 26, 2026.
And we really shouldn't frame this as just some boring earnings report.
No, definitely not. It's really a masterclass in what you might call strategic shrinkage. Because in a world that is just utterly obsessed with top-line growth, this document proves that sometimes getting smaller is the secret to getting stronger.
Yeah, no, totally.
Okay, let's unpack this. Because the raw numbers from this first quarter, they look pretty bleak at first glance.
They really do.
I mean, net revenues dropped 9.6% year over year, down to 440.7 million RMB. And then you look at their gross billings, which plummeted from 412.3 million down to 304.8 million.
And the student headcount, I mean, that took the biggest hit of all.
Oh, yeah.
New student enrollments crashed from 169,083 in the first quarter of 2025 to just 102,127 in this first quarter.
Which is a massive drop. I mean, if I'm just looking at the surface, it looks like they're holding a leaky bucket. Like the water pouring in has slowed to a trickle, and they're just losing what they already have.
Right.
It looks like a slow motion crisis for a business that relies entirely on subscriptions and courses.
Yeah, and it is entirely understandable why a casual observer would see it that way. But let's actually reframe that analogy a bit.
Okay.
They aren't holding a leaky bucket.
Right.
What the data actually shows is that they deliberately drained a massive sort of murky pond to tap into a deep, highly concentrated well.
Okay, wait, how so?
Because while all those top-line vanity metrics you just mentioned went down, the bottom line did something really spectacular.
Right, the profits.
Exactly.
Yeah.
Net income actually rose to 76.8 million RMB.
Mm.
And their net income margin, the percentage of revenue they keep as pure profit, that expanded from 15.4% to 17.4%.
Wow. So they are making less total money, but they are keeping a significantly larger slice of the pie. Yeah. But the obvious question is, how does a company survive a massive drop in new sales without immediately going into the red? Like, they must have some incredible financial buffer built into their business model.
They do. And what's fascinating here is the underlying financial mechanics of this education subscription model.
Okay.
It comes down to something called deferred revenue. So when a student decides to take a comprehensive course with Sunlands, they don't usually pay month by month.
Oh, right. They pay for the whole thing.
Yeah, Sunlands generally bills the student for the entire tuition of a course package up front, right at the time of the sale.
But under standard accounting rules, they can't just claim all that cash as official revenue on day one, right? I mean, they haven't actually delivered the education yet.
Exactly. That is the crucial mechanism. They have the cash in their bank account, sure, but on their balance sheet, they have to recognize that revenue proportionally over the entire duration it takes to deliver the course.
Ah, I see.
So all that upfront cash sits on the balance sheet as a liability to deferred revenue until the service is provided, month by month, lecture by lecture.
Got it. So it's essentially this massive holding tank of future guaranteed revenue. Like they've collected the water, they just release it into the accounting stream slowly.
Precisely. And as of March 31st, 2026, Sunlands had a deferred revenue balance of 500.5 million RMB.
500 million.
Yeah, over 500 million renminbi sitting in the tank. That massive balance acts as a structural shock absorber.
Wow.
It means that even as new billings slow down significantly, which we saw in that drop to 304.8 million, they still have a steady, predictable stream of previously collected cash being recognized as revenue.
That makes so much sense. It keeps the company highly profitable on paper and in reality.
Right, and it gives them the breathing room to execute a massive strategic pivot without panicking their shareholders.
Okay, well, here's where it gets really interesting. Because having a shock absorber explains how they survived the drop, but it doesn't explain how they actually increase their profit margin while bringing in less money overall.
That's the real magic trick here.
Right. And the answer to that is buried deep in their operating expenses. Because they slashed their sales and marketing expenses by a massive 19.5% year over year.
It's a huge cut.
Yeah, bringing the marketing spend down to 241.9 million RMB for the quarter.
Their finance director, Hang Yulei, actually explicitly noted in the report that this was the largest single-quarter reduction in selling expenses they have recorded in recent years. It's a fundamental rewiring of how they acquire customers.
Oh, wait, I have to push back on the strategy for a second.
Sure.
If an online education company just stops marketing, if they turn off the digital billboards and stop running acquisition campaigns, aren't they just starving their future growth to make today's spreadsheet look good?
It does seem that way.
I mean, it feels like selling the engine of your car to make it lighter so it goes faster down a hill.
Yeah.
But eventually you hit flat ground and you're just stranded.
Yeah, that would absolutely be the case if they were just taking a machete to the marketing budget blindly to hit a quarterly target.
Yeah.
But CEO Tongbo Liu addressed this directly in the press release.
Okay, what did she say?
He stated that these results reflect deliberate operational choices, and a key pillar of those choices is, quote, letting AI compound across the acquisition and delivery workflow.
Huh. Letting AI compound, that is a very specific phrase.
Very deliberate.
So they aren't just firing the marketing team and hoping word of mouth carries them. They're literally replacing brute force, human-heavy advertising with an artificial intelligence engine.
Exactly.
I have to assume this means they're moving away from massive call centers and those broad-stroke ad buys.
Yeah, let's look at the mechanics of traditional customer acquisition in this space. Historically, it is incredibly expensive and honestly pretty inefficient. You're buying millions of impressions on platforms like WeChat or Baidu. You're paying armies of sales representatives to make phone calls to lukewarm leads. You're basically throwing a massive net into the ocean and just hoping to catch a few viable fish. The waste is astronomical.
And the AI completely inverts that funnel.
Entirely.
Like, instead of a human marketing manager guessing which ad creative works best for a specific demographic, the AI is likely analyzing micro behaviors.
Right, the granular data.
Yeah. It sees that a user paused on an accounting certification syllabus for, 4 seconds, then compared a CPA page with a CFA page. The AI doesn't need a human to tell it what to do next.
No, it dynamically serves that specific user a personalized enrollment pathway.
Exactly. Maybe offering a targeted incentive at the exact moment their intent is highest.
And that is the compounding effect the CEO is talking about. As the AI ingests more data about what converts a high-quality student, its predictive algorithms just get sharper. It requires less human intervention, less A/B testing, and way less wasted ad spend. The efficiency just builds on itself over time. And, we could see the literal proof of this shift in the financials.
Where is that?
Well, while they slashed sales and marketing by nearly 20%, their product development expenses. So their R&D actually increased by 5.6%.
Oh, wow. So they are quietly taking the money they used to spend on shouting at the masses and they're funneling it into building smarter algorithms to hunt for the right individuals.
Exactly.
It's an incredibly sophisticated bait and switch on their own cost structure.
It requires a significant upfront investment to build that AI machine, of course, hence the increase in product development. But once that system is running, the marginal cost to operate it is just a fraction of the price of maintaining a massive human sales force.
Okay, so if they've shifted all this capital from human marketers to an AI targeting system, the AI must be hunting for a very different type of student.
Yes.
Because, as we noted earlier, their total enrollment numbers plummeted from 169,000 down to 102,000. If the AI is so brilliant, why did they lose nearly 40% of their volume?
So this is where digging into the fine print of the financial report reveals the entire strategy.
Okay, I love the fine print.
Yeah, so if you look at footnote number 2 at the bottom of the report, it explicitly defines what Sunlands counts as new student enrollments.
Okay.
And it states that this figure of 102,127 actively excludes orders of their low-price courses. They specifically name categories like mini courses and RMB1 courses.
The 1 renminbi courses. So these are essentially free introductory classes designed to artificially inflate user metrics.
Precisely.
Oh, that completely reminds me of a high-end restaurant strategy.
How so?
Well, imagine a Michelin star aspirant that for years sold $1 sliders at the bar just to get massive foot traffic in the door.
Okay, I see where you're going.
Right, so the place is packed every night, the volume metrics look incredibly successful, but those people are just buying the sliders, drinking tap water, and taking up space.
Yeah.
When the restaurant finally takes the sliders off the menu, the dining room is suddenly half empty. The total volume crashes.
Right.
But the only people left are the patrons ordering the five-course tasting menus and the expensive wine pairings. The volume goes down, but the actual profitability of the operation skyrockets.
That captures the dynamic perfectly. I mean, a one renminbi customer might look great on a user growth chart to show investors, but mechanistically, they still cost the company money.
Of course.
They still consume expensive server bandwidth to stream video. They still generate tech support tickets that require human or AI bandwidth to resolve. And they dilute the overall behavioral data of the platform.
Which hurts the AI.
Exactly. By intentionally stripping them out of the ecosystem, Sunlands gets a much clearer, unpolluted picture of their actual viable business model. CEO Tom Beaulieu framed this as a deliberate choice to raise the bar on learner quality and improve retention in our senior learning business.
Okay, so if they are dumping the casual one renminbi scrollers, I have to assume they are pivoting their focus entirely. Are they moving toward massive B2B enterprise contracts, selling bulk licenses to corporations?
Actually, no. The report indicates they are still intensely focused on the consumer market, but a very specific high-intent tier of that market.
Interesting.
According to the document, Sunlands is heavily focused on adult learners seeking serious credentials. We're talking about degree-oriented courses, formal diploma programs, and rigorous professional certification preparation.
So these are students who are investing serious time and capital to advance their careers, not people looking for a quick 10-minute video on hobby photography.
Exactly. But this raises an important question.
Which is?
How do you actually retain a student taking a complex multi-month certification course entirely online? I mean, the dropout rates for traditional online courses are notoriously high.
Oh, absolutely. And if you are charging premium tuition, you can't just hand them a PDF syllabus and a library of recorded Zoom lectures. You need infrastructure.
Yes, and the report highlights a proprietary knowledge management system they use called learning outcome trees.
Learning outcome trees. That sounds intense.
They are a fascinating mechanistic approach to educational R&D. Traditional online education is linear, right? You watch Module 1, take a quiz, then move to Module 2.
Standard stuff.
Right. But a learning outcome tree is a dynamic, non-linear knowledge graph.
Okay, so how does that work in practice for a student, like day to day?
Imagine a student preparing for a rigorous CPA exam. They take a module on tax liabilities and fail the practice quiz.
Okay.
In a traditional system, they're simply told to rewatch the same hour-long video.
Which is frustrating.
Very. But the learning outcome tree system analyzes exactly which questions they missed and identifies the foundational concept they lack. The tree then dynamically sprouts a new, personalized branch of remedial modules, specifically tailored to that exact misunderstanding.
Wow.
It adapts to the real-time cognitive state of the user.
That is incredible. It functions less like a textbook and more like a private, responsive tutor. And that system is precisely where that increased product development budget is going. They are investing heavily in the core product experience for the serious learner rather than marketing to the casual one. They are basically building a moat around quality.
And this strategic pivot requires immense financial discipline because even as they celebrate this highly profitable first quarter, their outlook for the immediate future is bracing for further contraction.
Really?
Yeah, they released their guidance for the second quarter of 2026, and they expect net revenues to drop another 20.2% to 23.9% year over year. They're projecting revenues to be between 410 million and 430 million RMB.
Man. So what does this all mean? If you see consecutive quarters projecting 20% revenue drops, is Sunlands just managing a slow, controlled decline, or is this the valley before a massive comeback?
Well, if we connect this to the bigger picture, the answer lies in the safety net they have built on their balance sheet. You really have to look at the sheer size of the war chest they are sitting on.
Okay, lay it on me.
As of March 31st, 2026, the company had 545.7 million RMB in pure cash and cash equivalents.
Okay.
On top of that, they held 236.0 million in short-term investments.
That is nearly 800 million renminbi in total, highly liquid capital.
They are exceptionally well capitalized to weather this self-imposed storm. Finance Director Hengyu Lee made a crucial point about this.
What'd he say?
He stated that this massive liquidity buffer gives them, quote, the flexibility to invest in technology and new business directions without being constrained by near-term financial pressure.
Without being constrained by near-term financial pressure. I mean, that is the ultimate leverage for any executive team.
Clearly.
You don't have to panic, slash prices, or run desperate marketing campaigns just to make payroll next month. You can execute a long-term vision.
Exactly.
It's less like a bear hibernating to survive a harsh winter and more like a massive factory intentionally shutting down its noisy, outdated assembly lines so engineers can secretly install state-of-the-art robotics.
Oh, I love that analogy.
Yeah, the output drops temporarily, and to the outside world, it looks like the factory is failing. But they have the cash to keep the lights on during the renovation.
That is the perfect way to visualize it. Sunlands is staying highly profitable by running on their deferred revenue, trimming all the unnecessary human marketing fat, and sitting on a pile of cash while they retool their entire ecosystem with AI.
Yeah.
The CEO explicitly noted that the new operating platform they have built positions them well for, quote, when market conditions turn more supportive, we are building with that horizon in mind.
Right. And when they flip the switch back on with the new robotics fully installed, their capacity and efficiency will just be unmatched.
Completely.
While their competitors might be bleeding cash trying to artificially maintain their market share by, giving away those $1 sliders, Sunlands is quietly compounding their AI capabilities and serving their core high-margin students.
It is a masterclass in having the courage to ignore vanity metrics in favor of structural integrity.
It really is. So, as we synthesize all of this, the core lesson here for you, learner, is that bigger is absolutely not always better.
No, it's not.
Sunlands didn't achieve its 20th consecutive profitable quarter by desperately chasing every single person with an internet connection. They achieved it by utilizing predictive AI to fundamentally alter their customer acquisition cost structure, by maintaining incredibly strict financial discipline, and by aggressively pruning their product line to focus entirely on high-quality, high-retention learners.
This is a powerful mental model that applies far beyond corporate finance or the ed tech sector.
Absolutely. Think about how this applies to your own workflow. Whether you are managing a complex corporate project, leading a small team, or honestly just organizing your own daily to-do list.
Right.
The Sunlands first quarter report is a glaring reminder that sometimes the absolute best way to move forward is to actively stop doing things. You have to ruthlessly audit your time and aggressively prune the low-value activities. You have to actively identify and get rid of your own personal RMB1 courses.
Yeah, you have to.
It is the only way to free up the time, the energy, and the resources to let your high-value, compounding core work thrive.
It is about developing the discipline to say no to pure volume in order to say yes to true value. You have to trust that the metrics that actually matter, like your margin, your deep impact, or frankly, your own sanity, will improve when you stop trying to be everything to everyone.
That is a brilliant strategy for personal and professional management. But looking at the source material, it also leaves me pondering the broader, perhaps disruptive implications of what Sunlands is building in the background.
Where does your mind go?
Well, we keep circling back to this mechanism of AI compounding in their workflows. If an online education company can already use AI to slash its customer acquisition cost by nearly 20% in a single quarter, replace human touchpoints with dynamic learning outcome trees, and maintain a 17% profit margin while intentionally losing tens of thousands of casual students, what happens to the broader education landscape in the next 3 to 5 years?
Yeah, that is the horizon they are silently building toward, while everyone else panics over top-line revenue.
Exactly. When the economic winter ends and the market conditions finally do turn supportive, as the CEO predicted, will the companies that survived by deeply integrating AI into their core operational machinery be so ruthlessly efficient that traditional human-heavy education platforms simply can't compete on price or margin?
It's a huge question.
Right. If you have spent the downturn trading the leaky bucket for the highly calibrated AI-driven machine, what happens to your competitors when it finally starts raining again? Something for you to ponder. Thanks for joining us on this deep dive, learner. We'll see you next time.